Moving Iron Podcast is proud to be part of the Global Ag Network. The network is going live soon, so check out globalagnetwork.com for more details and updates. Now on to the show.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast Tax Moves with Glen Birnbaum. Glen, how you doing, buddy?
Hey, good, KC.
Good deal, buddy. Hey, survived the cold weather, did you?
Oh yeah, we're warming back up now. So yeah.
So you had about 120 degree swing in temperatures between Wednesday and Sunday?
Pretty close, yeah. Hopefully it'll get some of the ground to tilt up and get some of that compaction out. So
that's crazy. It's that cold to that warm that fast. So that's nuts.
Yeah,
definitely nuts. Okay, so today we were talking about it. You posted something out on Twitter the other day. It caught my attention. It's called 163J, and it was interest limitation deduction. And me and you were kind of going back and forth on that, and it really kind of struck a chord with me a little bit. So, Glenn, explain what that is and how that works.
Yeah. It's this is probably the 199A code section has gotten a lot of press, and rightly so. But the other big one is 163J, which is an interest limitation concept that for the first time, really pretty much ever, for kind of your normal businesses, you might not be able to deduct all of your interests. And it's actually one of the biggest revenue raisers, from the perspective of the U.S. government, is that they're disallowing a portion of your interest. It's one of the biggest revenue raisers in the tax bill, actually. And the good thing is it generally only applies to businesses that have over $25 million in sales. So it's a pretty high threshold. But it obviously would apply a lot to, for example, farm equipment dealers, car dealers, that type of thing that, have a lot of inventory and have a lot of interest. So 25 million is the threshold, though. So it's pretty high. Like for farmers, most farmers aren't going to be at 25 million. We've talked about this a few times before. There's always an exception, Casey. So you can actually be subject to these rules if you're considered a tax shelter. We did a podcast on this. A tax shelter mainly means you have a loss during the year, and more than 35% of your losses get allocated to owners who are not really that active in the business. So again, may not come up too much, but if you have a true passive owner that's not a family member or something, you could actually get hit with this, even if you're under 25 million in gross receipts or 25 million in sales. So unfortunately, we're having to deal with this right now. It's kind of got pushed on the back burner. There's a public hearing at the end of the month here in February, but we're having to kind of look at returns right now and figure out how do we apply these rules. There's over 450 pages for these rules. It's crazy, the details on this. It's really insane. So we thought we'd talk a little bit more about how this works, in particular, like for a farm equipment dealer or somebody that has a lot of floor plan financing.
Gotcha. So just a little light reading for the weekend, knock out those 450 pages and be ready to go by Monday, right?
Yep. And they've been out since the end of November, so
okay, plenty of time.
We've had plenty of time to look at them.
Yeah, good to go. Okay, so let me throw out a scenario to you here. We'll throw out some scenarios. Yeah. Okay, so if I'm a farm equipment dealership, I've got I got a floor plan of whatever, $25 million, right?
Yep.
All that is either, it's all inventory that I either have it's used inventory or it might be also maybe half new, half used type of stuff. So I got $25 million laying out there. What are some of the scenarios that I'm looking at here as an equipment dealership?
Yeah. So again, they put a special exception in that said, hey, we're going to give you a break if you have a lot of if you're a type of business that pays a lot of interest. It's just part of your operation, right? And it's floor plan financing, and it's for inventory. Generally speaking, it's motor vehicles, is the definition. And a motor vehicle is either a self-propelled vehicle, designed for transporting people. It's also boats, and it's also farm machinery and equipment. So you want to be kind of part of this exception, because we'll get into this, but basically they say, hey, if you have floor plan financing, basically floor plan interest is fully deductible. There's a catch. We'll get to that later. Okay. But notably, construction equipment is not considered a motor vehicle. You had asked the question on the podcast several months ago that what about construction equipment that is used by a farmer? They actually addressed that question in the proposed regs and said, no, we're not going to consider that. So farm equipment is good. Floor plan interest is good. They have a special rule that says, yes, you can deduct it 100%, but there's one catch. And the catch is you would not be eligible to take bonus depreciation on any property that the dealership placed in service. So maybe you don't have a whole lot of equipment, but if you're leasing, so it's either inventory that you're held for sale, it's available for sale, right? Or you're leasing it, either one. So if you're leasing equipment, you would not be able to take bonus depreciation. If you've got, vehicles that, your salesmen are using, you would not be able to take bonus depreciation. If you have certain maybe potentially leasehold improvements that you're doing to the property, you wouldn't be able to take bonus depreciation. But I think as a general rule, they said, well, most dealers are going to be okay not taking bonus depreciation, because they said, I'm sure this was negotiated, hey, we'll give on this as long as we can deduct 100% of our floor plan interest.
Okay. All right. So when you say okay, so I just want to make sure I understand this correctly, just so it's clear.
Yeah.
Okay, you said anything motorized, right? So if I'm a farm equipment,
self-propelled vehicle, designed for transporting people. So presumably a motorcycle would count.
Mm-hmm. Well, what about like a planter or a disc or a?
Okay, it says farm machinery and equipment count.
Okay, so it's a blanket
considered
statement.
A motor vehicle.
Okay, so anything about that counts, right?
Yeah, it's not. So it's a good. Luckily there's a special provision that is in place, but along with that, I should have mentioned this. This is a permanent election. Like as soon as you, I'm wrong on that. For the farming business, we talked about a farming business gets an option to opt out of these rules if they want to. If they're over 25 million, that's a permanent election that you make. The floor plan interest is an annual thing. So if you can actually pass the test. So we didn't really get into this. The general rule is it's going to be 30% of EBITDA. So if you're don't have any special rules, you're don't have floor plan interest, you're over 25 million in revenue, it's going to be 30% of EBITDA, which is earnings before interest, taxes, depreciation, and amortization. You take that number, you take it times 30%, that's all the interest you can deduct. The rest carries over. So it's not a terrible thing. It's not like you lose it, but it carries over. So 30% of EBITDA is what you have to deal with. So, in other words, you get to add back interest, right, in order to calculate this number. But for construction equipment, you don't get this rule. Remember that. Farm machinery, you do get the rule. But if you want to say, well, I don't want to follow the rule because I want to take bonus depreciation, there still might be a chance. This is where it gets real complicated. Basically, instead of adding back all interest, you would only add back your non-floor plan interest, right? So if you had debt on, a building or something, you would get to add that interest back, run through the calculation. You say, well, you know what? There's an extra $35,000 of interest that I could deduct because I have enough income, right? My 30% calculation. So I've got an extra cushion of $35,000. Then you could say, okay, I can deduct then $35,000 of the floor plan interest. So maybe it helped to go through just a quick example how this works. I was just using some rough numbers. You only have $100,000 in net profit. Okay, $75,000 of that is depreciation. So if you go and do the non-special rule, you say, well, I got $175,000 of EBITDA because I don't get to add back any interest because all my interest, I got $300,000 of floor plan interest, and all that That's the only interest I have. So I was figuring, Casey, $300,000 of floor plan interest is like $7.5 million inventory times 4%. Just kind of a rough number. But anyway, I would only be able to add back depreciation because I have no other interest. So $100,000 of my profit plus $75,000 of depreciation is $175,000. I take that times 30%, and I can only deduct $52,000, $52,500 of my interest. Not very much. The other $247,500 in this example would carry over. So it's a big deal, right? If you're not making much money net, but you got a lot of floor plan interest, $247,500 would carry over. So that's why they didn't really want this to happen, because that's just too much to not be able to deduct. So the only good thing about that, okay, I've got $247,500 of interest to carry over, but I could take bonus depreciation. Probably not too likely that I would, I'd rather have a $247,500 deduction. So what they did is say, well, I want to make sure I can deduct this interest. So you work through this other calculation, and basically you work through the other calculation. We don't have time to get into it, but you'd be able to fully deduct the interest in that calculation. They let you off the hook, but the catch is you can't take bonus depreciation. So very complicated rules, extremely complicated. But I think most dealers are probably going to end up probably being okay. They're going to have to be okay not taking bonus depreciation, just because the interest is so significant in relationship right to your profit. I mean, it's just part of the cost of being a dealer, and you can't afford not being able to deduct your interest. So
right. Okay, so if you are a dealer that leases, say, I guess I'm a little confused. So if you're a dealer that leases, say, vehicles, right? You lease the vehicles that your sales reps drive or your parts guys drive or whatever that might be. Yeah. How does that work into this deal?
Yep. Okay, so I think you're talking about, vehicles that you don't own, the dealership doesn't own, they're leasing them from somebody else, right?
Right, yep.
I think is what you're saying.
Right.
So that's totally fine because lease expense is fine. What I'm talking about is the dealership owns some equipment.
Oh, okay.
And they lease it out to farmers, right? On operating leases, yep. Where they are, it's inventory available for lease. And so you obviously own the equipment, so you're paying interest, right, to somebody because you still own the equipment, right? The farmer doesn't own the equipment. The farmer's not paying interest, right? They're paying lease payment to you. So you've got the interest expense because you still own the equipment, your leased fleet. So if you want to be able to deduct all that interest, you're probably going to have to give up bonus depreciation. Now, you might remember there's 100% bonus depreciation now. Used to there was it was only 50% bonus or 30% bonus. So it's crossed, it's went around, but that's the give is if you want to make sure you can still deduct all your interest, you're going to have to just not be able to maybe write off the leased equipment quite as fast as you used to. If that makes sense. So in theory, if you have a $100,000 piece of equipment, right, you could write it off 100% with bonus depreciation. That'd be an expense of $100,000, and maybe the farmer only paid you, $15,000 lease payment or $20,000 lease payment on operating lease. That would be your income. So you'd have a net negative, loss, right? If I'm using $20,000 of lease income, $100,000 of depreciation, I've got an $80,000 loss. So they're just not going to let you kind of do that, right? Because that $80,000 loss could offset some other income you might have. They're not going to let you take that heavy, fast depreciation if you want to be able to still deduct your interest. So Gotcha. It's probably not a huge, it can be a big deal, but as long as you're kind of okay writing off the equipment that you're leasing to somebody else over the life of the lease, right? Hey, just kind of gradually expensing it, not a big deal. But if you're looking for that heavy depreciation, you're gonna be caught between a rock and a hard place.
Gotcha. Okay, so what you're saying is if I have 10 or 15 combines that I'm going to rent to customers during wheat harvest or corn harvest or whatever else, that falls into that realm.
Yep.
Gotcha.
Yeah. So I don't know, how you normally would depreciate those. But if you don't, if you create a big loss and you can't use it anywhere, there's no real point in taking all this heavy depreciation. If you're just looking to take as much depreciation to offset your lease income, then it might not be a big deal. But it gets tricky because potentially then you could be taking those combines that you own, right, and then you trade those off to somebody else and get different combines. Normally, in old rules, you would not have a gain on sale of a trade. We've talked about this several times, right? So if the equipment dealer could have a similar situation as anytime they trade off some of their inventory, they would have this leased inventory. I'm talking about something that you actually started depreciating. This leased inventory, they trade that off. You'd have a gain equal to the trade-in value, right? Just like you sold it. So you'd have this big gain. Now, normally they say, well, that's okay now because I'll just be able to write off the new item and those will wash, right? We've talked about that several times, like from a farmer perspective. It's not that big a deal. But think about what we just said. If a farm equipment dealer is now precluded from taking bonus depreciation because of that interest thing, then they're going to have a real challenge if they trade off their leased farm equipment. They're going to trigger this gain on the trade and not be able to write it off 100% unless they could technically still take like Section 179 expense up to a certain limit. But it could be a problem from that perspective too. Again, because you're voluntarily giving up bonus depreciation. So you may not be able to write off that gain on the trade. So that's just something to be aware of too.
Right. Well, like normal, Glenn, there's lots of stuff to consider here, and you're on top of it because you've read all 450 pages of the
something like that.
Of the code.
It's one of the bigger revenue raisers out there because they're trying to tell people, this could be other partnerships, investment, type funds and stuff. Hey, don't use. In effect, they're kind of saying, don't use as much debt, because they're not going to let you possibly deduct it immediately, and so it's one of the biggest revenue raisers out there. But it's so complicated because it affects these more complicated partnerships and things, and how you pass out this. Hey, this is your share of the interest expense that you couldn't deduct this year. Here it is. Keep track of it at your personal individual level, and then next year when possibly there is income that flows out, you'll be able to take that carryover interest expense and offset it. So it creates a whole lot of additional tracking at the partner level potentially. So it can get real messy, and a lot sometimes, right? The tax preparers prepare the entity returns, the partnership returns. Maybe they're not the same as the tax preparers that prepare the individual personal returns. So just going to have to be more communication. Making sure we're talking to each other, and it's just going to be confusing if you've got a partnership interest in particular that you're invested in, and they're using a lot of debt.
Right on, man. Okay, well, Glenn, hey, this is one of those things where you're going to absolutely need someone, a tax advisor, somebody like that to kind of help you wade through this. So if folks want to reach out to you, ask some questions about this, or just kind of get pointed in the right direction, how would they do that?
Yeah, it's best to call our office at Heinold Banwerts. We're based in East Peoria, Illinois. Our phone number is 309-694-4251. And then, look me up on Twitter. My handle is at Glen Birnbaum.
Right on. If you guys aren't following Glenn, make sure you do that. I know I say that every week here, but the stuff he puts out there is very pertinent information, and not only is Glenn putting it out there, but he has a lot of other tax professionals kind of weighing in on what he puts out there. So there's a lot of great information out there for free. So check it out and get a hold of Glenn if you got any questions. And Glenn, till next week, we'll talk to you then, buddy.
Okay, Casey, thanks.
Well, that's going to do it for this edition of the Moving Iron Podcast. Remember, if you want to continue any of these conversations, you can hit me up on Facebook, Twitter, or Instagram at Moving Iron LLC. You can also send me an email at movingironpodcast@movingironpodcast.com. You can also visit the Moving Iron Podcast YouTube channel. Here you can find Morning Market Roundup with Chip Nellinger and Angie Setzer. Also, Tax Moves with Glen Birnbaum. Moving Iron Podcast is proud to be part of the Global Ag Network. The network is going live soon, so check out globalagnetwork.com for more details and updates. You'll be able to hear Dryline Farmer Podcast, Girls Talk Ag, the Topsoil Podcast, Ag News Daily, Working Cows, Heifer Please, Throwback Iron, and Ask Agnes. Please visit movingironllc.com. Here you can find information, details, and updates for the 2019 Moving Iron Summit in Nashville, Tennessee. If you'd like to support the podcast, you can leave a review and subscribe at your favorite podcasting platform. And you can find this podcast on iTunes, Google Play, Stitcher Radio, TuneIn Radio, and SoundCloud. So until next time, let's go move some iron. This is Casey Seymour. Out.
Moving iron in the 21st century.